what we wanted to do is really introduce our newest add-on, and that is by Mr. Joe Duffy, and he is a very, very highly accomplished trader. He's had a long career as an institutional prop trader, trading system developer, and a financial writer. He has actually competed and is a top 10 finisher 3 different times in the United States Trading Championships. He's had very, very large real money annualized returns in those championships. He has also managed a proprietary FX trading book for one of the world's largest banks. And we've been working with Joe for a little while now, getting some of his systems within Metastock, and we've been impressed the entire time because of the types of results that his system is getting through our system tests, etc. So I'm really excited to have his add-on with Metastock and to have him here today to explain a little bit about how his system works and what his methodology is. So without further ado, I'll turn the time over to Joe. Joe, can you hear me okay?
Yeah, Hunter, I can hear you. Can you hear me?
Yes, I can. I'm gonna turn you straight over to the presenter role here.
Okay. Let me know if it's all good.
I see Metastock. What a beautiful chart that is.
Okay, perfect. Okay, we're not going to dwell. Thanks for the introduction, Hunter. Today what we're going to talk about is trading myths and wisdom. And the topic isn't going to be exactly about the add-on. We'll talk a little about the add-on at the beginning and a little bit at the end. But what I'm going to talk about today applies to everything that you do. And there may be some ideas in here. I'm sure there are ideas you haven't heard before. And hopefully what we're going to do today is make you question some of the things that you have accepted as common knowledge. Because personally, I'm not sure they are. I'm not going to try to tell you what to think or to change your beliefs, but I want to give you some information that perhaps will make you broaden your horizons and look at things a little differently. So before we get into that, I'm just going to briefly introduce what the product looks like. And this is Scoupe Suite on your screen right here. The great thing about it, I guess, is that, as Hunter said, it runs on System Tester, so you can verify your results. It runs across the universe of stocks, and obviously indexes, ETFs. You can even run it on intraday. So we'll talk about that in a little bit, but as you can see, all these are mechanically generated by the system, they are not icons put up by me. So we'll talk about that a little bit about that at the end. But let's get started on the what we came for here today. Okay, here's the topics that we're going to cover, and as I said, market axioms and traditional wisdom. And the right is the things that we're going to go through and perhaps give you, in a couple of instances, some different perspectives, or perhaps some perspectives you hadn't thought of. Before that, I want to just talk to the idea of how limiting our belief systems are. And Mark Douglas, before he passed away, one of the pioneers of psychology and trading, talked a lot about how hard it is to deflate a belief system. So what I'm going to ask you to do today may test your believability or whatever, but that's the point. I think every time there's been a great step forward in business or in sports, it's because somebody did something differently. You know, when Bill Walsh introduced the West Coast offense in the NFL, it was different. Where Patrick Waugh became a butterfly goalie, it was different. You know, Elon Musk says that one of his great quotes that, one of his better quotes was that one of his best feelings is when there's something that everybody tells him is, that isn't the way you do it, or, that's impossible to do, and he knows absolutely that that is going to be the way to do it. So I'm not going to suggest that what I'm going to tell you today is the way to do it. All I'm going to suggest is that you have an open mind, and maybe 1 or 2 things may give you some ideas for adjusting the way you do things in your own trading. Okay, let's talk about what the market knows and what the market doesn't know, because it does actually know some things. Okay, it does know where it's been. For instance, it recognizes highs and lows. It recognizes particularly how far it's come off the low or how far it's come down off the high. Don't obviously, the further it goes, the more chance it's going to have, you know, a corrective bounce the other way. So it knows sort of where it's been, where its highs and lows are. What it doesn't know is where you got in. Okay? It doesn't care and it doesn't know. So what should we be basing our decisions on? Well, we always talk about our risk reward or whatever based on our entry level. But there's more information there than that, and I think that we should be using it. For example, let's take a trade, exact same methodology, and we're going to have, let's say, a 60-point stop on it, 60 ticks or whatever you want to say. Exact same trade, same methodology. The first trade we do goes 50 ticks offside, and then comes back our way and is, you know, moving to profitability. The second trade we do goes only 5 ticks offside, and it comes back to profitability. Now, if your profit target is, let's say, 100 ticks, which one has a better chance of getting there? Well, you know, statistics will tell you that it's clearly the 5-tick one. But if you're basing things solely on risk reward, you're not going to adjust your parameters at all. And I would question whether that's the right way to do this. Okay, before we get, and we'll talk about risk reward and some other things related to it, but I wanted to give you the flavor of what this was going to be about. Okay, the first thing that I want to talk about is entry versus exit. In the last few years, there's grown this philosophy and that exits are more important than entries. And it's hard for me to believe that it's gained such a foothold, but it seems to have. Okay, you cannot make money trading without an entry edge. An edge being something that's provable and quantifiable that gives you a way to get in the market. You certainly cannot take random entries or poor entries and put your magic exit formula on and turn them into profits or make money. That should be obvious. If there was such a way to do that, you would just put on, you know, different trades in different markets all the time, and then just put your magic entry edge, exit edge on, and you know it would take care of everything. And that's clearly not the way that it goes. I think that, in my opinion, this whole emphasis that exits are more important than entries is remember that old game they used to play with the which P is the shell under? Watch the shells move around and then guess where the P is really taking your eye off what's important. You need a good entry. Okay, you can exit the market suboptimally with a good entry and still make money, but the opposite, it does not work. Speaking of how we get out of markets, any entry edge that you have, and we're going to talk about one again with the Scoupe Suite in a bit, should work with the most basic exits only. So when you're doing testing on Metastock, if you want to find out if you have an edge, the one that I find is the best is testing with an exit that says, I'm out after 1 bar, 2 bar, 3 bar, 4 bar. You can just run the optimal variable up from 1 bar to 50 bars or whatever you want. And what you should see is that if it's truly an edge, there'll be at least a grouping of exits where you're making money. If you're not, or if it's random and it's 2 is up and 3 is down, then you might have that's more luck than your edge. After that, don't go and start torturing your exits trying to make this thing work. If the entry has any edge at all, it'll work with the most rudimentary and simple exit. Okay, here's another important one. I think the exit entry is really important to make sure you are focused on the right thing. Risk, reward, and probability. I put the 3 of them there because we normally only hear about risk reward. Probability is just as important. And risk reward and probability are like a teeter-totter. They have a very high inverse correlation, and when one goes up, the other goes down. It doesn't have to be 1-to-1, but most times it's going to be pretty close. Okay, now which of these two strategies would be better? We have 70% winners in 1-to-1. That is, we risk 10 points to make 10, or 40% winners and we risk 1 point, but we have to make 2.5 points. Well, the answer is they're both the same. If in the first one you win 7 times 1 point, you're plus 7. And if you lose 3 times 1 point, you're minus 3, so you're net plus 4. On the other one, if you win 4 times 2.5, you're 10, and if you lose 6 times 1 point, you're 6. So you're net 4. So those systems are the same. So not to say one is better. The only thing I would question here is how many times do you get 2.5 times your risk? Not that often, maybe 40% if you've got a good system. I'm not poo-pooing the fact that you can certainly go with a 40% 1 to 2.5 system. It depends on your entry strategy and the market you're trading and so forth like that. But we all know for sure that markets tend to chop around more than they trend. So once you start to get into you're looking at 2.5 times your risk, you're asking for the market to trend. And it doesn't do that all the time. Not sure it does that 40% of the time. In my experience, it's quite possible to get 70% accuracy and a little better than 1-to-1, honestly. So I would really, this is the most important one I think today that I'd like you to question. You know, we all have this, I think we bring with us to the market because there's so much about it, this thing that the trades has to be 2-to-1. And people will say, oh, well, you can be 50% accurate, and if you're making twice as much as you lose, you're golden. Well, it's really, really hard to be 50% accurate and 2-to-1. Okay? Not the only then, if you're only that, or I've seen it written that, oh, if 1 in 10 of your trades is 5-to-1, well, geez, you know, if 1 in 100 of my trades was 5-to-1, I'd be happy. You know, it's not that easy. Okay, so this is one I'd like you to question, and depending on your entry edge, both ways can work, but I think that you can even go a little bit less than 1-to-1, and I'm going to show you why in a bit here, but keep an open mind and remember that risk, reward, and probability are like a teeter-totter. They're both important, and probability, I think, has been left by the wayside, and a decent edge may only last a short period, but that little burst will give you enough to have a high accuracy. Okay, so consider that when you're looking at your own trading. Stop loss strategies, tight or loose. In all the research that we've done, if you keep too tight of a stop, you end up dying the death of 1,000 cuts. Okay, so you're better off with a broader stop to start with. The other thing that we look at, and this goes back to the exit that I talked about before, when we say exit after 1 bar, 2 bar, 3 bar, 4 bar, just to test the strategy, you'll find that time is important. If you have an edge, what you'll see is that that edge will start to dissipate over time usually, and your accuracy at least will decline. So when you're looking to get out of trades, especially at stop loss, how long you're in the trade is important, because your edge, when you've tested it, will have been able to tell you how long does this edge usually last. And when it starts to get past its expiry date, and you haven't hit your objective yet, then it may be time to start looking to move the trade out by either lowering your profit objective or just getting out. So time and price are important on the exits. Okay, now we're going to talk about adapting your exits, and this kind of goes back to that what I talked about before, where if you have a 50, if your trade's 50 ticks offside or 5 ticks offside and it's the exact same entry, which one has a better chance of being not stopping you out, and which one has a better chance of hitting the profit objective? Well, clearly the 5 tick done was. But if you're using the sort of model that comes to us in the market of, oh, what's your risk reward, and that's the end of it, then you're using your entry price, and you're using this static risk reward model that doesn't take into account that the market doesn't really care where you got in, and you're also not taking into account what the market price has done since you've got in. Two very important things. So what I would call it is, you can either adapt to what the market's doing and listening to what the market's doing, telling you, or you can try to dictate to it with, okay, here's my risk reward, and that's it. So it's, to me, adapt and thrive or dictate and die. Okay, now obviously your initial risk reward can be based on your entry level. But after that, we want to adjust based on market action. One of the ways that I do it, if I'm using daily charts, and I probably think most of the Metastock audience is probably end-of-day traders, if I've got an edge and it goes my way either 2 consecutive days where it closes above my entry, it's in my price, or maybe 2 out of 3 days, what I do then, and this, again, I didn't pull this out of my hat, we've done a lot of work, you know, back testing and so forth on these kind of things. But if you get that market moving your way, the best thing to do is move your stop to 50% of your initial stop. So if you had a $2 initial stop on the stock, now you've got a $1 initial stop or stop. But that's only after the market is showing you that it's gone your way for a couple of bars, or at least 2 out of 3 days or something like that. Then you can cut your risk in half. Not to break even. We'll talk about break-even stops later, but we don't do that. So what you're doing is adjusting your risk reward based on what the market's showing you. Now, as I said before, I think 1-to-1 is okay, or 1 to 1.5 is a great first objective, either one. And now if you've cut your risk by 50%, now your 1-to-1 trade now is a 2-to-1 trade. And if it was a 1 to 1.5 trade, now it's a 3-to-1 trade. And most of the markets, if you have an edge, are going to at least show you something in your direction, even if it doesn't get to your first objective. So if you've got an edge that's 70%, probably 80 or more times it's going to at least show you enough to move your stop. And that will allow you to move that risk reward in your favor. Now similarly, if you're offside the 50 points, let's give you another example. I've got a trade that with a 60 tick stop and it goes 50 ticks offside, and then it starts to come my way again. Now, if I had entered there, so let's say I've got a 100 tick stop, and so it's gone halfway to my stop. If I had entered there and still kept that same stop, I'd be risking 50 points. And if I'm trying to make, you know, say 2 points, I've now got this now has to move 2.5 points or 50 points to the stop. So now I've got a 5-to-1 risk reward trading. As we already talked about, how many times are you going to get a 5-bagger? Almost never. So if the market starts to go more than halfway to your stop, the smart thing to do is to start to lower your profit objective. Okay, so if the market does bounce back your way, you know, maybe even a scratch looks good at that point. Okay, the closer it moves away from you, the less greedy you have to be. A corollary to this, and it's really not something that it's not a tested thing, but I sometimes when I'm trading, I remember the gift horse rule, which is if you're in a trade and you're getting buried, maybe you've moved your stop or whatever you did, doesn't matter. We've all been in situations where we're getting buried. And the market comes back anywhere close to even, don't look the gift horse, okay? You've probably done it. It's come back to even, then you think, oh, boy, I'm going to make money on this after all that. Don't. You know, whenever you've got a gift horse trade, just get out, okay? And it ties into the same philosophy here about adjusting based on market action rather than you telling the market what to do. Let the market tell you what it is doing and then react based on that. Okay, break-even stops. Break-even stops feel great. You know, you move your stop up to break even, you can't lose. You know, trading's stressful, the stress is out of this trade, oh boy. But unfortunately, the break-even stop is the poster child for what doesn't work in successful trading. Unfortunately, trading is all about being uncomfortable, okay? Whatever feels comfortable in trading decisions, the market's the antithesis of what makes you feel good. Anything that seems like it should work or seems correct or makes you feel good is probably the wrong thing to do, okay? And the break-even stop's the poster child for this, okay? You get a little profit, you move your stop to break even, almost all the time it's just going to stop you out. So if you want to move your stop early, just get out. In all our testing, until the market's moved 85 to 90% of the way to the first objective, don't move your stop to break even. You can move it certainly to 50% up. I think that's a great way to do it once the market starts to show you something, but don't move it to break even. Okay, it's not a winning strategy, and we've tested it a lot. Now, if you've got multiple exit strategies that we'll talk to in a minute after it hits the first one, then you can move. So if you've got 1 to 1 or 1.5 to 1 on your first objective, then you can move your stop to break even. But not before that. It just doesn't work. Okay, multiple exits. This is where, if we buy 500 shares or 5 contracts, if we're trading futures, or 5 units or we're trading Forex or whatever, you divide your units up and you separate exits on the same entry. Okay, there's nothing better or worse about multiple exits. The only thing it does is smooth your results. Okay, because each of those exits has to be considered a separate entry, or a separate system, sorry, a separate strategy. If each one of those systems or strategies on its own doesn't make money, then they aren't contributing to the whole. And I think people often forget that. All multiple exits does is smooth your equity curve. Now, I've seen strategies where people recommend buying 500 shares or whatever, and then selling 100 as soon as you can cover your commissions plus a little bit. That's an absolutely horrible skewed risk reward. We talked about that it can be a little less than 1 to 1, but it can't be 50 to 1 against you. Even if it's 95% accurate, or 98% accurate, it's still not good. So be wary of that sort of a philosophy which I've seen out there, and remember that each one of your multiple exits is really its own strategy. Now, the good part about multiple exits is that it does smooth the results. So for instance, if you do get a market that pops up, hits your first objective, and then comes back down, you've at least got something out of it. Another time the market pops up, hits your first objective, and then keeps going, well, then you have a second objective for it. Okay, so no matter whether the market's just chopping around or whether it's trending, you're going to get something in both of those cases. Neither one is better than the other. It's just going to smooth out your results over the long run because you don't know which of those situations is going to occur, obviously, before it does. So multiple exits don't make the system better or worse. All they do is smooth the equity curve, but keep in mind that each exit you use is its separate strategy. It has to stand on its own. In terms of trailing stops, you see this sometimes too. Oh, I'm trailing the stop. It sounds great, like you're going to make a boatload. Everything we've tested, very rarely does trailing stops really work. You're better off, if you're going to trail a stop, have a generous objective as well. You're better off to pay yourself than you are to trail your stop in all the work that we've done. And that's our general philosophy, is you have to pay yourself. You are going to leave some on the table, whether you trail your stop or whether you pay yourself when it's going your way. You're going to leave some on the table no matter what. Our experience is, and our testing is, that you start to pay yourself. And the last point of multiple stops is, or multiple exits is, your first objective, you should take at least 50% of your position off. At least 50%, because if the market goes there and that's all you get, you need to have at least 50% of it being a winning trade. 25% is not enough. It's not going to cover you for the times where the market goes there and then turns around and you end up losing on the other 75%. You need to, or at least break even on the other 75%. You need to take 50% off, which is a good number, at your first objective. Normally, I just divide my trades into 50-50. Occasionally, based on just more feeling about it, I might divide that last 50 into, 25-25 again. Okay, we're going to talk about Scoupe Suite right now, and it won't take very long either. We talked about, or briefly before, what an edge is. An edge is just something that you can test using something like the Metastock strategy tester, system tester. We talked about how anything you use should have positive results with rudimentary exits. The best rudimentary exit that I know and that I use is exit after opt1 bars, and you can run your opt1 between 1 and 50 or whatever, and you'll see if this entry edge is really an edge. Okay, it will show you right there if it is. Okay, if it isn't, don't start torturing the data by trying to tweak things. This has got to hold up over the long run, and torturing historical data to try to tease the results out of it isn't the way to build an edge. Okay, so, and that's how we've built our edges, and we'll talk about that when we get to Metastock right here. Okay, this is, again, the API mechanical system. This is the SPY that we've got up here. I'll show it on a couple other things as well. Underneath it is a different strategy. It is an indicator called Scoupe. Obviously, the API system speaks for itself. The arrows are the buys, and the buy exits are there. We've made it very simple, one buy, one sell. Obviously, you can adjust that on your own and use this as a tool. Now, the very great thing about the API system that's shown here is that, and this is really, really important, all the testing was done using the opens. And why that's important is because, again, I could have made this system look way better by torturing the data and giving you a much better equity curve, and I'll show you the equity curve in a couple of seconds, but that isn't doing you any good. By using the open, what we have is a parameter that's the same every day. It's not optimized, it's not curve fit, it's not tortured. Okay, it's just the same every day. And from the user perspective, 99% plus of the time, the open's not going to be the best price that day. Okay, so you're actually going to be able to do sometimes substantially better than what the system is showing. And that's a very important thing, because if we had tortured the data and used these exact entries we had to get, well, if you don't get them, then what do you do? This way, you've got all the time to decide what you want to do, using this as a tool, using it mechanically however you want. Okay, just basically the Scoupe below it here is an indicator. You can also run it. We also run tests on it. If the histogram, which is the blue part, is positive, and the red line, the Scoupe line, comes underneath it, at least down to the first level of buy zone there, then that's a positive. Okay, I'll talk to Scoupe in a minute. I just want to backtrack a little bit here, and we'll scoot back on the data to show that it does give signals on both sides of the market. I just have to find, okay, you know what, it's been a while. I don't have enough data loaded, I guess, to see where the sell signals were, but there have been sell signals. Obviously, this trades both sides of the market is what my point is. It can also even go, in fact, no, I know what that is, because this is the hourly. This is the hourly SPY I have up here. I'm going to put it back on the daily so you can see. That's another great way to show that this isn't optimized, because if you take any system and throw it on the hourly and throw the same system on the daily, if it's been curve fit or optimized, it's going to go completely kaflooey. Okay, this system works on both hourlies and dailies, weeklies, and it works on the whole universe of stocks. Obviously, some better than others. You look at your history before you decide. Okay, now I've switched it to daily now, so now I can go back. So there's my short signals here. Okay, and it exits there and exits there. Okay, so there are some short signals in here. It does trade both sides of the market. Okay, obviously when the market's going up, it wants to be long, and you can see that's what it is. So another small short signal here. Okay, so that's how that works. Again, completely mechanical. You just run it. Okay. Let me go run it to show you that I work on a couple of stocks too. first of all, let's take a stock that hasn't been doing that well. In fact, let me see. Give me a second here. Okay, so we're going to look at General Electric, which is a stock that's been done poorly. So let me apply my template here. Okay, oops, sorry, this is back to Scoupe. Let me just apply, I applied the wrong template, my mistake, I'm sorry. Okay, so again, basically there's a downtrend and we're selling exact same rules. Obviously, we haven't changed the system. It's the exact same rules. So it adapts. Let's look at it on Amazon. Again, everything's done at the open, so that's a huge advantage. If you're a user, you have tons of opportunity between the open and the as the day goes on to figure out what price you want to use, or even the next day. Okay, so again, it's basically buying the dips in the uptrend. That's what it does. That's the most successful strategy that we found for systems, is find what the trend is, identify the pullback, and then figure out how to get in, and that's what this does. Okay, what this also lends itself very well to is option spreads, exceptionally well. So if you want to do option credit spreads in the SPY or even individual stocks, this is fantastic for that. Historically has about 74% win rate and a little over 1-to-1 if you use just the first exit there. So weekly options and so forth, it's fantastic for setting up credit spreads. Okay, and a credit spread would be you buy an out-of-the-money put if you're bullish, and then sell one that's right at the money. If they're, say, $2 apart in the SPY, you're going to get a little over $1 credit for that. $1.20 credit, which means you can make $1.20, but you can only lose 80 cents no matter how far the market goes against you. So you couple that with the fact that you've got 74% winners, you're using the option time value in your favor, and it's a fantastic way to trade with options. Okay, so that's the mechanical system right there, and the Scoupe here below it is not part of the system. It's a very similar philosophy, but it's not actually part of the system. So let me go and show you how the Scoupe works as well. We've got a couple of versions of the Scoupe here. Basically, once you see the little diamonds, that's a sort of permissioning that, okay, we want to be buying the next dip, okay, and then the circumstances have to be positive for that. So you'll get a little 1, which is the most aggressive buy. I don't generally recommend taking the 1s. There's a 2 and a 3, which, as you can see where my cursor is here, is the buy there. Here's the 1 and the 2 again right here where my cursor is, and so forth. All right, so you obviously you got some sell signals too. You got one here, which was well, it was offside a little bit, but eventually went your way. This is more of an indicator. You can test it, and there are tests for it in there. And if you just test it, if the oscillator is positive, or sorry, if the histogram, the blue one, is positive, the Scoupe line moves below 40 or moves below 75, which is the red line here and the green line here, and then exit after an n number of bars. You'll see that on most things. It provides you with some good entry points. So that's the Scoupe. Again, these are very basic. They both follow the same philosophy of figure out what the trend is, wait for the pullback, and then get in on it. Okay. So this is more of a tool I use. The API you can use as a tool, but it's a mechanical system. In fact, let me run. One of the things we want to do here is let's run the API system. Okay, on the SPY. Okay. So it's about 50% better than a buy and hold strategy for the S&P. So it makes 50% more money than a buy and hold, but you can see that it does so at considerably less drawdown. That's a very smooth equity curve. Starts in 1993, so you got about 25 years of history there. Okay, so that's how that works. And I think that pretty much says everything I have to say about the Scoupe Suite. Again, you know, what's the trend? Identify the pullback, how to get in. The system does that. The system can be used as a system like it is, as is, or as a tool. Either way, provides you with some great signals. Very useful for option trading as well. Or stock index trading, futures, or ETFs. So I don't know if there's a facility here for questions, but if there is any, I'd be more than happy to entertain them.
Sure, and you know, while I'm kind of wrapping up here, you know, feel free out there in the audience if you have any questions, type them in the chat box. I'll read them off to you, Joe. Actually, one is popping up now. Tim asked, does it run on end-of-day data? Yes, it does, Tim. It runs on end-of-day as well as real-time, and like Joe explained, it does cover all markets. The next question is, what about...
Can I interject there, Hunter, for sure?
Yeah.
The API was really designed around the stock market. All right, so you know, every market has their own little characteristics. So if you ran the API in the euro, you wouldn't get as good of results. Now the Scoupes, which is the indicator below, is applicable to any market, okay? Because it's more of an indicator and a tool. But certainly the Scoupe Suite, you can run across a history of, you know, the S&P 500 or whatever you want, and most stocks you're going to do pretty well.
Okay. The next question, Scott asks, what about buying directional options like calls?
Well, sure, you can. I think that you can, absolutely. I think that the strategy lends itself better to the credit spreads. One, you're starting off with a 74% edge, which is the historical winning rate since 1993. When you do a credit spread, and they're not that expensive to do. Like I said, if you do them in the SPY and they're $2 apart, you know, it's barely going to be more than doing a call or put outright, and in fact maybe less, and your risk is limited. Okay? Well, of course your risk is limited in the call too. It could expire, but in the credit spread, if the thing starts to go offside, you don't really have to worry because your downside's always protected, and you're getting the premium working for you. Obviously, when you're buying a call every day, a little bit the premium erodes. Well, what we've done is just flip that over and let the erosion work for us. Okay, sure. If the market skyrockets and you have a call, you can make 4 or 5 times your money. Absolutely. And if you get into an option credit spread and the market skyrockets, you're going to make your $1.20, and that's all you're going to make, doesn't matter how high it goes. However, when you combine the 74% historical win rate with the fact that you've got options time premium working for you, you're going to raise that probably over 80%. And you've got a little better than 1-to-1 when you're writing the credit spreads. I mean, geez, it's a fantastic strategy. Buying calls and puts outright, obviously you can do that. And I do it. It's a strategy that probably has its place when you're pretty sure the market's going to take a bigger move, but in terms of just pounding the market all the time, with this system, I would prefer the credit spread for sure.
Okay, wonderful. Let's see here. Do the indicators help in setting strike prices for credit spreads?
Here's what I would do is just, you sell the at the money, and if you're using the SPY, you buy it out of the money that's 2 points away, $2 away. So I like when I mean at the money, let's say that the SPY is 265. Okay, so if you're going to sell the put because you're bullish still, then you sell at 265 put, and you buy the 263 put for less money. Obviously, you say buy one for 30 cents, and you sell the other one for $1.40. So you've got $1.10 credit, and that's what you stand to make is the $1.10, and the most you can lose is the 90 cents. So you don't need the indicator to tell you which one to sell. If you want to slide it a little bit and you really think it's going to go your way, you can sell one that's a little bit in the money if you want. I think at the money, all the market has to do is go sideways if you sell the at the money. If it goes flat sideways, you're going to make the entire thing.
Next question, does the system have commentary? Yes, Ann, it definitely does. It has a wonderful expert commentary, and that's one of the big features of Metastock is you're able to watch a webinar like this, spend an hour of your time listening to Joe talk about his methodology, but Metastock, the commentary is always going to be there to walk you through the trades and what the signals mean, etc. So we spent quite a bit of time with the commentary on this. It's a wonderful commentary.
Right, and I always answer my email as well.
Yeah, and that's one of the things. It is Joe's always here to help. We're here to help as well. Obviously, we're not going to give you any specific trading advice, but we can teach you how to use the system. Joe's going to have a lot better insight into how he uses his system and how to interpret certain signals. Tim asks if it does come with a manual. Yes, it does. It's not a physical manual, but it's within Metastock. It's within the commentary. And again, if you need help running exploration, system tests, or anything like that, you can always give us a call or let Joe know, and he'd be happy to walk you through it.
But again, even if you're a relatively new user to Metastock, Hunter, I mean, really, it doesn't take, you could have started Metastock yesterday, and you'll know from this chart here what it's telling you.
Mm-hmm.
These aren't hard to use, and there's really not a whole lot of, well, it could be this, it could be that. I mean, the histogram, this one, obviously the API system is clearly straightforward. Scoupe is, if the histogram is bullish and the oscillator comes back down underneath, then it's an opportunity to buy the dip. I mean, that's as simple as it is, guys.
Yeah, and that's one of the things that I like about this add-on, and I'm going to change the screen over here and show a couple of the things that come with this add-on. The Scoupe Suite comes with 4 system tests, a template, 9 explorations, 4 expert advisors. And one of the things out there in the audience to keep in mind, this is one of the systems that actually come with system tests that you can run. Now, we always say, and you'll hear most traders say that past performance is no indication of future profit, and that's a disclaimer that everyone puts out. But as technical analysts, that's exactly what we're looking at. We're looking at the previous results to see if it's indicative of future movement. And Joe's system tests very, very well. We've run a lot of tests ourselves on it, et cetera, and that's one of the things that I really like about Joe's system is it's very straightforward, it's easy to use, the commentary is great on it. Most importantly, you can go back and see the results for yourself. Now, when you're running the system tests, just make sure to change those system test options to where it's realistic as to how you trade before you run that system test, and you can go back and say, well, if I had been trading this API system over the course of the last year, how would I have done? And then that will be able to help guide you here in the future. Okay, so it's definitely a great system. We're very excited to have it. Here are the systems that are included: the absolute performance indicators,
which is the Scoupe.
Right.
Yeah.
And then we have a couple of other, so 4 altogether systems that are included with it. Here is a screenshot here. I want to throw up a screenshot of the commentary that's involved with the Scoupe add-on. And like I said, very, very easy to apply. If it's something where, you know, again, these signals are very, very straightforward, but if in the beginning you're really trying to make sure you're interpreting it correctly, just add the commentary on there and it's going to walk you straight through the system.
Yeah. One of the cool things that you guys did too, Hunter, and I didn't have it originally, was you guys put in the little numbering system. I think I showed it there before, where you've got a 1, 2, and a 3. So the 1 is kind of really an aggressive entry, maybe more of a warning, and the 2s and 3s are where you probably want to get in. That makes it even more clear. I mean, it's really, you know, if it's got a number 2 or a number 3, then hey, off you go. You know.
Yeah, exactly, and it's something where you know, Joe has a wonderful system, and we tried to use a little bit of our modest expertise on what works well with add-ons, and how you out in the audience can just view a system and have it visually make a little bit more sense to you, versus having a ton of different indicators on a chart simultaneously. This breaks down a very simple system in a very easy to use way. Now, this add-on, normally this add-on is $3.99 in price. This is something where we've worked with Joe for a little while, and you know, we were very, very glad to be able to put this system into Metastock. What I've been able to do is actually discount this for, and this is for individuals that register for this webinar. This is not a normal sale price. We're going to put a little bit of a time limit on it as to how long this promotion is good for. But the Joe Duffy's system, you can get everything that we talked about today. Normal price, like I said, is $3.99. We're going to do a sale price of $3.49. We have some sales associates in chat right now, so you can go to metastock.com/sales chat. Feel free to shoot us an email. Contact us and just mention that you went to this webinar, and we'll give you the $50 off. And, you know, of course, after that, we're always happy to walk you through, and I'm sure that Joe would be as well. Joe, thank you very much for doing this webinar today. I was excited to have you here and to kind of break down your methodology a little bit, and I'm sure we're going to be doing more of these here in the future.
Okay, my pleasure. Thanks, Hunter. Thanks, everyone, for coming.
Yeah, and out there in the audience, like I said, give us a call if you have any questions on it. Chat in or give us a call to take advantage of this $50 savings. And,
yeah, just let me mention, sorry.
Yeah, go ahead.
Yeah, no, so I was just going to say, if they want to contact me, the website's jdtradingsystems.com, jdtradingsystems.com. You'll see that the price is offered at a higher level for other people, for sure. So we're going to have to talk about that too. But my email's there. I answer it. So if you need to contact me, you can feel free. jdtradingsystems.com.
Wonderful. Thanks again, Joe, and to all of you out there, I appreciate you attending this webinar this evening, and as always, happy trading.
Okay. Thanks again, guys. Thanks, Hunter.